Welcome to the Pro Ticker Deep Dive. Today, we are wading into what is, I think, one of the most fascinating financial paradoxes unfolding anywhere in the world right now.
Yeah.
We're talking about the banking sector and the Gulf Cooperation Council, the GCC.
It really is a unique environment. And, it presents this fundamental tension if you're trying to understand the investment landscape there. On the one hand, this region is just absolutely flush with capital. And it's in the middle of this unprecedented infrastructure boom.
Unprecedented is the word for it.
We are talking about something over $2.65 trillion in infrastructure planned through 2028. I mean, that level of spending should make banks just unstoppable.
Right. You'd think if you have that much credit flowing into an economy, profits should just be soaring. But here's the twist we need to unpack. The shift in the global interest rate environment is now squeezing their core business profitability.
Exactly. So what we're analyzing is a sector that's navigating this sweet spot of extreme historic credit growth against a backdrop of shrinking net interest margins, or NIMs.
So the big question is how? How are these banks not just surviving this pressure, but actually maintaining seriously robust profitability?
Yeah, the data is pretty clear. We see return on equity, or ROE, which is, basically how efficiently a bank uses your money to make a profit. It's sitting at a really sturdy 13.2% across the whole sector.
And that is our mission today, to extract the key insights. How are they doing this? And what does this whole transition mean for the future of growth in the region?
And we can't forget the foundation this is all built on. The macroeconomic fundamentals are incredibly strong. The IMF is projecting regional GDP growth of 3% this year, and that's accelerating to 4.1% in 2026.
Those are impressive numbers, especially when you look at the sluggish growth elsewhere. And for some of the individual countries, the forecasts are even more striking. The UAE, for instance, has raised its 2025 growth estimate to 4.9%. Saudi Arabia is looking at a robust 4%.
Right. And that economic momentum isn't just a theory on a spreadsheet. It's translating directly into business for these banks. If we start with the macro engine that's driving all this, the real story here is the strategic pivot away from just relying on hydrocarbon wealth. They are actively reimagining their entire economy.
And the government initiatives behind this are just massive. I mean, we're all hearing constantly about Saudi Arabia's Vision 2030.
Which has already catalyzed over $1 trillion in announced investments. $1 trillion. In everything from tourism to tech.
Wow.
And that strategic push is, it's mirrored across the Gulf. You can look at the UAE's national policy for economic clusters. It's all about boosting GDP by targeting high-value sectors.
But this diversification isn't abstract. It shows up immediately as credit demand, right?
Immediately. The infrastructure spending is the physical output of this huge wealth shift. And the sheer scale of the projects flowing through the bank's loan books it's staggering.
We're talking about huge, multi-decade projects.
Oh, yeah. The GCC railway network, the gargantuan NEOM development, huge new city construction like Lusail City, and then you have massive Dubai metro expansions.
So here's where it gets really important for a deep dive. This is fundamentally a credit-driven boom. The banks aren't just sitting on government money. They are the essential conduit for this whole transformation.
They're the engine grease. They're providing the project finance, the syndicated lending, all the trade finance for importing materials, and, the critical working capital for every single construction and engineering firm involved.
And we have hard evidence of this demand. Saudi Arabia's banking sector reported loan growth of, 15.8% year over year through the first half of 2025? That's a blistering pace.
It is. I mean, compare that to loan growth in most developed economies, where you'd be lucky to break single digits. The UAE saw strong growth too, 10.4% in the same period. And if you look at a major player like Emirates NBD, they reported record lending growth of 19% in just the first 9 months of 2025.
19%. So demand is not only aggressive, it's accelerating. Okay, that gives us the bull case. Massive credit-fueled economic growth. But now let's unpack the paradox. The rate environment.
This is the central tension. Because GCC currencies are pegged to the U.S. dollar, their monetary policy is, it's essentially tethered to the U.S. Federal Reserve.
Meaning if the Fed moves, they have to move.
They have no choice. So when the Fed began cutting rates back in September 2025, all 6 GCC central banks had to follow suit immediately. A 25 basis point cut, just like that.
So explain this for us. Why does that hurt profitability? You'd think lower rates would stimulate even more lending.
And that's the paradox. You're right, lower rates are fantastic for stimulating new credit growth. It feeds the boom. But the instantaneous repricing of their existing loans, all the loans they made when rates were higher, That, combined with fierce competition for deposits, immediately squeezes their net interest margins.
The NIMs. So that's the difference between what a bank earns on assets like loans and what it pays out on liabilities like our deposits.
You got it. And when rates fall, the bank earns less on its old loans faster than it can lower the rate it pays you to keep your money there. The data shows that immediate impact. NIMs compressed by 20 basis points. They fell from 2.8% down to 2.6% in just the first half of 2025. And more pressure is expected.
That seems like a big squeeze. And you mentioned competition for deposits. Is all this rapid loan growth creating a bit of a funding problem too?
It absolutely is. It's creating a serious funding squeeze because loan growth it's outpacing deposit growth significantly.
So they're lending money out faster than people are putting it in.
That's right. I mean, look at Saudi Arabia. You had that incredible 15.8% loan growth, but deposit growth was only in the 6 to 8% range. So that dynamic pushed the sector-wide loan-to-deposit ratio, the LDR, up to 94.1%.
And that's up from about 90.7% the year before. So what does that number, 94.1%, actually mean for you, the listener?
It tells us how much of a bank's cheapest, most available customer funding they've already lent out. And while 94.1% isn't, a red alert danger zone yet,
It's getting close.
it means they're nearing the practical limit of using cheap customer funds. So to keep up with that 15% loan demand, they have to turn to more expensive avenues.
Like wholesale funding.
Precisely. Borrowing from money markets. And that costs significantly more, which just puts even more pressure on the income compression we just talked about.
Okay, this brings us to the crucial part of the story.
Right.
The solution. How are they aggressively offsetting this pressure to keep that 13.2% ROE intact?
This is where they're being really smart. They are executing a definitive pivot toward non-interest income.
So making money from fees and investments, not just the spread on loans.
Exactly. And the numbers on that pivot, they're dramatic. In Saudi Arabia's banking sector, non-interest income jumped a massive 26% in the 9 months ending September 2025.
26%.
And Emirates NBD's non-funded income surged by 20% in that same period.
But 26% jump sounds aggressive. How sustainable is that really? Isn't some of that going to be volatile?
That's a very important question. And you have to look at the sources. The money came from 3 main areas: trade finance, wealth management fees, and investment gains. And you're right, the investment gains were particularly big. Saudi National Bank, for instance, recorded a 35.5% increase in investment gains.
So a third of that surge at one of the biggest banks came from their investment portfolio. That feels like the volatile part.
Yeah.
You can't count on big one-off gains every year.
You're absolutely right to point that out, which is why the other layer of income is so critical here. We're talking about the stickier, more predictable fees.
Right.
And there we're seeing solid, sustained growth, something like 8% to 12% year over year in wealth management, trade services, foreign exchange fees. These are recurring revenues tied to actual economic activity. That's what gives you long-term stability.
So diversification is pillar one. The second must be operational discipline, just keeping costs down.
Absolutely. That ROE stays sturdy because of their focus on efficiency gains. We track this with the cost to income, or CI, ratio.
CI ratio, let's break that down. It's basically how much money the bank has to spend to earn a dollar, right?
That's the perfect way to put it. And a lower number is better. The sector-wide CI ratio improved to 32.0%. Leaders like Emirates NBD are getting as low as 30.5%.
How are they doing that?
Through aggressive digital transformation, automating processes, optimizing their physical branch footprint. It creates a huge operational advantage.
And before we look ahead, what about the safety buffers? Do they have the capital to keep lending this aggressively?
They do, and this is a key differentiator. Asset quality is strong. Impaired loan ratios. So the percentage of loans that are unlikely to be repaid are incredibly low. We're talking 2% to 2.5%.
And their capital.
Their capital ratios are fortress-like.
What does fortress-like mean in actual numbers?
It means their Tier 1 capital ratios, the highest quality capital they hold, are typically between 14% and 16%. When global regulators might only require 10.5% or 12%, this gives them an enormous buffer to support years of sustained growth without needing to raise more money.
Okay, so let's look forward. Given this whole tension, what are the catalysts for the bull case? What should you be watching for?
First, that project finance momentum is not slowing down. That multi-trillion-dollar infrastructure pipeline means project finance and trade finance fees will stay robust for at least the the next 5 years. That demand is sticky.
And lower rates have to eventually trickle down to the regular consumer.
They do. Lower rates are consumer tailwinds. We're going to see accelerated consumer lending in things like mortgages and auto loans, and that caters directly to the young, affluent demographic in the region.
And third, that digital push you mentioned, it's about more than just cutting costs now.
Exactly. It's generating new revenue streams with lower risk. Emirates NBD's digital wealth platform, for example, surpassed AED 5 billion in trading volumes in its first year. That's low-cost, scalable fee income.
Okay, now let's flip it. What about the bear case risks? Where could this story start to go wrong?
The biggest immediate concern is that margin persistence. We've already seen that 20 basis point squeeze. If the U.S. Fed cuts aggressively, say another 50 to 75 basis points over the next 2 quarters, NIMs could compress another 30 to 40 basis points.
That would be a major profit hit. Even the most efficient banks would feel that pain.
It would be very painful, especially for the smaller banks that don't have those big non-interest income streams. Second, those funding constraints we talked about. If deposit competition really heats up and wholesale funding costs spike, that rising loan-to-deposit ratio could become a real problem. It could force them to slow down lending.
And finally, competition. Are the fintechs a real threat?
Absolutely. They are aggressively eating market share in specific areas. Remittance, buy now, pay later, simplified wealth management. The big banks are responding, investing billions in their own platforms, but if their execution lags, they could see those fee incomes start to erode.
What's so interesting here is the overall positioning. It feels like the sector is in that early cycle phase.
That's a great way to put it.
Loan demand is outpacing deposits, NIMs are under pressure, but profitability is holding up because of that diversification.
Right. And this phase can historically sustain for a good 2 to 3 years before you even start worrying about classic late cycle problems like credit defaults. The focus right now is just cost management versus fee generation.
So that's the synthesis right there. The sector's resilient, it's transitioning from oil-dependent to diversified growth, and the banks are the financial backbone making it happen. The real question is execution.
Which means you, the listener, have some clear things to monitor. Watch for sustained loan growth. Is it accelerating, like Emirates NBD revising guidance to the low 20%? Track that non-interest income. Is it fueled by sticky fees or those volatile investment gains? And of course, keep a close eye on the Fed's rate path to see when NIMs might finally stabilize.
And a final provocative thought for you to consider, the current valuation multiples for the Saudi banking sector. They're around 10.99x price to earnings. That's quite modest for an environment with 4% plus GDP growth and a 13% return on equity.
It suggests the market is still pricing in the risk from rate cuts, but maybe not fully pricing in the success of this diversification pivot. If that non-interest income growth keeps surprising to the upside, there is significant room for those valuations to re-rate higher.
See you all in the next Pro Ticker Deep Dive.